In this lecture, we will review financial economics, investor preferences, and how they affect the rating and pricing of a financial asset like stock, bond, and or real estate. The various possible financial assets will be reviewed throughout the lecture. The impact of arbitrage on asset price and the rate of return will be discussed as well throughout the chapter. And lastly, we will take a look at the security market line and its applications. So here are the content of the chapter: financial investment, the present value of money and future value, some popular investment, stock, bond, will be reviewed, calculating investment return, arbitrage, and we'll discuss the risk and comparing risky investment. And we'll conclude with the security market line and its application. So what is financial investment? So in this chapter, our focus will be more on financial investment, which include buying any asset, regardless of it is new or used. Right? Financial investment can either be financial asset, such as stocks, bonds, or a real asset, real estate. Right, real asset like land, building, equipment. You recall that economic investment, unlike financial investment, economic investment refer to buying new addition to the capital stack or new replacement for a worn-out capital stack. So here we're just going to focus on financial investment, right? The broad sense of financial investment. The value of money, the present value. So the present value of money is one of the most concept in business. So understanding the concept of time value of money help to explain why you keep your money in your house. It's not a good idea at all. The fact that the future value of money is less than the present value of money can help you make a decision and need it in the future. Compound interest. Compound interest explains how quickly an investment increases in value when the interest is paid not only on the principal, but on the principal plus the interest earned for the previous year. We will illustrate the concept with example of $100 today. If the interest rate is 8%, what the $100 will worth in 1 year, and 2 years, and 3 years. Okay, so this table illustrates the impact of compound interest rate, right? And the impact that the compound interest rate will have over time. So in the column one here, you have all the years, and you have the computation of the compound. And here is the value at the end of each year. So you can see here that if the interest rate is set at 8%, the future value is the current value time 1 plus the interest rate at the power of the year. So basically the 2 year, at the end of the 2 years here, you will see that it's still the 100 initial investment plus multiplied by 1 plus the interest rate 8% and the power of 2, which is the year. So the key to calculating the present value of an asset is to understand first the asset future payment. This is what you will receive in the future for the asset. In addition, you must also know the interest rate. Those are the two components that is expected in the future and how far into the future the payment will be received. So if you know the interest rate and how far in the future the payment will be received, you'll be able to calculate or determine the future value of your investment. Now let's look at the application of the concept. Right. So here, if you take, you end up being a lucky lottery winner, and you need to get paid over a certain number of years, but you decide to get the money because you don't have those years, and you decide to take a lump sum today, the concept will be applied to give you the value of that money that you're supposed to take in the future, a number of years in the future, and you want it today. The formula gonna bring or help to calculate the value of that money today and give it to you. So understanding the present value is useful in making a decision, right? So one being the example of a lottery winner, you want the money upfront, or you want to wait until and get a installment payment over a number of years, or you want the money upfront, right? So you will say which option is better. It depends on your preference, because the amount you will get is the same amount. If you wait and get it, over time, or you get it upfront, it's still gonna be the same amount. The concept is also used in the professional sport team, and it helps you to understand why, for example, no single professional sport team will have all the top players, right, as the team are subject to salary cap and deferred compensation arrangement that even out the playing field. Popular investment. To some extent, investment sound like a gambling arrangement. Why? Because they all have these three characteristics. Right? You must pay to acquire the lottery, you must pay to acquire this the investment. A chance to receive a future payment, yes, and some risk in the future payments. Right. But one thing to to point out here is that there's a chance you will receive money in the future in investment compared to lottery. The amount and the likelihood of a future payment is questionable. Investment are more secure and the probability are higher than if you compare to lottery. Even though above you have the same features that you must expect to acquire them, chance to receive a future payment, and there's some risk. Investment are typically more secure, and the probabilities are higher than if you play state lottery. So the first investment type we're gonna review is a stock. And what is a stock? A stock is represent your ownership in a corporation. Right? So investing in stock is one option, and a stock is your ownership share in a company or equity. There's a risk that if the company fails, the investor will lose his investment. But the key advantage of owning stock is that it provides ownership, what we call limited liability, meaning that the most they can lose is the amount they pay for the share. And creditor cannot come after the owner if the company goes bankrupt, owing more than the value of the asset. And also buying stock, owner also get to share the financial gain of the firm. When a business make money, it will distribute some of the earning to the owners or people who own the stock through what we call dividend. Right? Owner also can make money through capital gain. And capital gain is basically when you purchase a stock today and the value of the stock appreciated, and you decide to sell at a higher price. You earn more money because you buy it cheaper and not selling a higher price. So you get what we call capital gain. The next one is bonds. Bonds are a little bit different from stock and issue either by a government or corporation. So, and bond represent debt security and are traded on the market the same as a stock. The key difference between stock and bond is that the bond is more predictable. Future payment are fixed as the amount and the time that you purchase the bond for. The default risk of the bond depend on the type of a bond. Right? Bond issued by government are more safer as the chance for government to fail is very slim. But with corporation, the risk depend on the health of the company itself. all bond issuances are rated for risk by a varying rating agency, such as Moody or Standard and Poor Index. Bond prices are inversely related to interest rate. As interest rate rise, bond prices go down and vice versa. Mutual funds. Mutual funds are very popular because they help to distribute investor risk. Mutual fund can tailor the portfolio to satisfy the desire of the investor. Index funds are designed so that the portfolio exactly match a specific stock bond index, which is something that follow the performance of a particular group of stock bond. So actively managed fund have a portfolio manager, someone that do the arbitrage by buying or selling the stock to meet the investor need. And a passively managed fund, or rather asset tied to the underlying index that the fund follow. So you can see here that actively managed fund will require more cost because of they had to pay the manager that manage the fund versus the passively managed fund. This table highlights the 10 largest mutual funds in the country as of March 2019. One thing to keep in mind here is the list is subject to change as market conditions change. How we calculate investment return, right? Investment return are the gain or loss stated as a percentage rate of return. So the rate of return is calculated by subtracting the amount paid for the asset from the amount for which the asset is sold. And then you divide the difference by the amount you pay. So to that point, you will see that the higher the price paid for the asset, the lower the return rate will be. So that is the inverse relationship between the price of the asset and the return rate. Right. And you see this more mostly where there's a fixed future payment flow as I think as a bond where the future payment are fixed, right? You will see that inverse relationship between the price of the asset and the rate of return. Arbitrage. What is arbitrage? Arbitrage is just the process by which profit-seeking investor buy and sell asset in attempt to equalize the average expected return, the average expected rate of return on a similar asset. By going through the arbitrage, investor is able to minimize the risk involved and the process will bring both assets into equilibrium when they return, the rate of return on the similar asset are the same. Okay, so we're gonna see the illustration of arbitrage in the next slides. Risk. Investing is much like a gambling that we said before. In the world of investing, the risks simply refer to the idea that an outcome lacks certainty. Right? You are not sure, you are uncertain about the future payment. The outcome could be good or bad. You just don't know it. How much risk an individual is able to handle is a personal preference. Some investors enjoy the excitement that comes with a lot of risk, right? While others prefer to take a safe route. One way to minimize risk is to diversify, which is a strategy of investing in a large number of investments to reduce the overall risk to the entire portfolio. The old adage that don't put all your eggs in one basket still holds up today. Even with diversification, there's always be a risk involved in investing, right? Because we have also the non-diversifiable risk, right? And those type of risks cannot be eliminated. Right? The business cycle is an example of a non-diversifiable risk. You cannot protect yourself against a business cycle. Right? There's no way to diversify away from the risk that the entire economy may collapse. Investors typically use the average expected rate of return or better, right? Better to evaluate risk. Right? The average expected rate of return is a probability weighted average of investment possible future rate of return. Okay. And beta here is the measure of the risk, right? Risk on non-diversifiable risk. So beta is a relative measure of a non-diversifiable risk. It compares the risk of a given asset with that of the market portfolio. We contain every asset available in the financial market. The risk level and the average expected rate of return are positively related, meaning that the higher the expected rate of the return, the higher the risk involved for the asset. And this relationship applies to all type of asset. Right? And there are a few totally risk-free investment. The only investment considered to be risk-free is a short-term U.S. government bond. Right, this bond or short-term loan to U.S. government, right, with term ranging from 4 to 26 weeks. And the only way they will not be repaired will be that if a U.S. government collapse, right, in the short term, which is very slim for U.S. government to collapse in the short term. And since these are risk-free, they typically pay low rate of interest, right? Many, the return rate for those risk-free compensate the investor just for the time preference, not for the risk, because they are risk-free asset. So this global perspective just show you the international differences in risk, right? So you can see that the higher the rating, the less risky and more safe the asset is. So this shall show you the three safest, three riskiest, and a few between. So you see the safest and the riskiest, and what we have between. Right. From less risky to riskier. Comparing risky investment. The two most important factors affecting investment decision are return and risk. The non-diversifiable risk are especially important in order to be able to compare a different investment opportunity. Investors need to be able to measure the return and the risk. The average expected rate of return is the probability weighted average of the investment's possible future rate of return. The risk can be measured through a statistic known as beta, right, which measure the non-diversifiable risk of a particular asset by comparing its risk to that of the market portfolio, containing every asset available in the financial market, right? And U.S. government bonds are considered to be the one investment that is risk-free for all intent and purpose. So if we shift to the next one as illustration, I will introduce you to the security market line. And security market line indicate how compensation for time preference, right, as well as the amount of non-diversifiable risk is calculated. And the market, the security market line is based on a basic assumption that any investment average expected rate of return should be equal to the sum of the compensation for the time preference and the risk involved. So you can see here that the average expected rate of return is the sum of the rate that compensates the investor for the time preference and also the compensation related to the risk involved. So anytime there's an investment that provides you a higher expected rate of return, think twice, because that higher expected rate of return include if the time preference, the time are the same, so that higher expected rate of return is because of there's a higher risk involved in the investment. So the market, the security market line slope upward, right? Because the investor must be compensated for higher level of risk, right? With a higher average expected rate of return. For a market portfolio, better is one by definition, right? Better the risk level is one by definition. And the exact location, the exact location of the intersect here is determined by the Federal Reserve monetary policy, right? And how it affects the rate of return on a short-term US government bond. And the slope is determined by investor feeling about risk. So let's look at the next graph. So here we have, you see that the average expected rate of return will compensate investor for the time preference, right? In addition to the risk, which is better, right? So the Y here is the sum of the better, right? And the compensation for the time preference, compensation for the risk plus compensation for the time preference. This graph illustrates arbitrage. So arbitrage here can ensure that all investment having an identical level of risk will also have identical rate of return. So the graph show you asset A, B, and C, all sharing the risk, the same risk level here, which is X, or they're all sharing the same risk level. And consequently, they all should lead to same expected rate of return, but they are not. Originally, they are not. C is somewhere here, B is Y, and A is even give you higher expected rate of return, right? So you can see that even though all these three assets initially have a different rate of return, arbitrage gonna pressure quickly this asset, right? But eliminate the difference in between them so that they all can yield the same rate of return. So example, since A here have a higher rate, how investors are going to behave, they're going to rush in to purchase A because A yield to higher return. And by rushing to purchase A, it will drive up the price of A, right? Because more demand for A, the price gonna goes up, right? The price will increase. And when the price increase, the return gonna go down, right? Same way for C, they're gonna get rid of this asset because the asset provide lower return, right? They're gonna get rid of it. And by getting rid of it, the price the price will go down. And once the price go down, you'll see that the return will go up. So by doing that, they will have a downward pressure on asset A and upward pressure on asset B. And you see that they all having the same level of risk gonna end up having the same expected rate of return. So they're gonna restore the equilibrium. And an increase in risk-free rate of return by the Fed will cause the security market line to shift up, right? And since the risk-free rate to determine where the security market line intersects the y-axis, right? It will affect both the average expected rate of return and the asset price. Yeah, let's see some application of the security market line. The action during the recent recession illustrate that investor behavior cannot be predicted at all. Right? Usually, during a recession or during time of recession, when we have a lower interest rate, stock market will rise because when people put the money in the bank, they are not earning much. So the option they have is to invest on the market, on the stock market. So the market stock rises, right? As an investor, move to the market looking for higher return. Right? In the case of the recent recessionary period, the investor became fearful about losing the investment in general and began to seek more secure investment. The increase in the slope of the security market line overcame the decline in the risk-free rate of interest, and that led to this stock market to fall. Right, so you can see that it's not easy thing to do to try to predict investor behavior. So here we will look at index fund versus actively managed fund. In the long run, there's no way to beat the market and an index fund. So index fund, which are tied to indices of a specific stock, right, usually overperform actively manage a fund, right, which is the asset in which the asset are individually selected by a fund manager. In addition to not performing well, they actively manage fund usually have a higher maintenance fee, right? Since they have to pay the manager who manage the fund or perform all the transaction. There's also transaction costs related for the trading that the the fund manager, engage to achieve the desired return. So now the question is, if the passively managed fund overperform actively managed fund, why people still opt for actively managed fund? Right, the answer is probably the same as why people buy a state lottery ticket, knowing that the odds of winning is the odds of winning are astronomical, right? But people still buying because there's always a chance, there's always exception, and I hope that you will be that exception to win the lottery.